Today, I'm going to talk about index funds. A lot of you will have heard about index funds. You might have some people telling you should use index funds. I want to lift the lid and dive into what makes index funds, and so we can consider, should you use them for some or all of your super. And I'm going to take you through a bit of an education process and show you a few examples. So firstly, and let's get the slide. Yeah, I don't know your stuff. This is all general advice. Good information, but you should do your own research or get advice before acting. We put everything into context always, and for this, we're at step number 3, about 5 essential steps, which is where we're talking about strategy, particularly super and investing, and whether we should use investments. Now, note, these are tactical questions, so before you dive deep into tactical questions, you should make sure you've got a plan so that you know your strategy fits the plan, and you'll see other stuff there for us. All right, let's get in, and let's start talking about what is an index fund. So an index fund is an investment vehicle, and by investment vehicle I mean a managed fund or an exchange traded fund. So I'll just pause on that for a minute. So managed fund, things you can pick in your super. Your existing superannuation might have options for index. Now, it can also be an exchange traded fund. An exchange traded fund is listed on the stock market, and that means you can buy it just like you would buy shares. I'm going to show you some examples of these. And 2 good examples straight up are the S&P 500, which is the US share market index, and the ASX 200, which is one of the Australian share market indexes. Now, you hear about these on the news at night. You'll hear when they get to the business news, they'll say the S&P 500 went up 1% today, or went down 1% today, and the All Ordinaries or the ASX 200 went up or down. So when they're talking about that, they're talking about the index. So what is it? It's passive management. Yeah, an index fund is not trying to actively pick stocks. They're trying to just duplicate the index, and they do that quite well. VAS, Vanguard Australian Share Fund, and plenty of others mirror almost exactly what the index does. So when you hear the news say it's gone up 1% today, you can safely know that your index fund that's tracking that has done exactly the same thing. Now, I'll get on to why that's a good thing, because some people go, oh, doesn't that just get your average returns? And that's a complicated answer. It gets you, ironically, better than average, but I'll talk about why in a minute. It gives you the chance to get massive diversification. So if you think about, if you were trying to, before index funds, and index funds came about in the 80s, they were started predominantly by a company called Vanguard, and the founder of that company was a guy called John Bogle. He passed away recently, and he was an amazing man. He changed investing massively. Index funds are much lower cost than traditional managed funds, so he was responsible for creating the vehicle that would eventually lead to lower costs for all of us in investing. But you get this instant diversification. So if you buy the S&P 500, within that index, you're getting exposure to all 500 stocks within that index in one fund or in one purchase that you buy through your online broker. ASX 200, you buy that, you get exposure to 200 companies, and they keep adjusting it for the market exposure. So they're replicating the index exactly. Whereas consider if you tried to buy a diversified portfolio of shares, you might need to buy 15, 20 stocks to get a decent diversification. Then you've got to maintain it. You've got to hope you pick the right stocks. And it's not easy, even though some people make out that it is. Index funds are very low cost, and you're going to see some of the fees in a minute. But instead of paying, traditional managed funds ranged for their management expense ratios anywhere from 1% to 2%. They've got cheaper in the last 5 to 10 years because of the pressure that index funds have put on them. But before that, they were typically 1.5% of the cost of what was being managed. Now, if they were adding value of more than that, happy days, that's value for money, but most weren't, as I'll illustrate in a minute. So all of a sudden, you can get exposure to the S&P 500, so that's the US share market, the whole US share market, for less than about 0.05 of 1%. So it's a fraction. Instead of 1%, 0.05. So that's 20 times cheaper and even more. The ASX 200, about 0.05 to 0.07, depending on which one you pick. So these are incredibly cheap. You're paying almost no management fees. And that's not surprising because they're not actively managing the portfolio. They are managing it to the index, which you can think about as just a giant spreadsheet that's run by the exchanges, whether that's in Australia or Wall Street or other exchanges around the world. Now, they're simple. Now, some people don't like simple in investments, but I love simple in investments. If it's simple and it achieves your purpose, then it's much easier than trying to do it in a much more complex way. So trying to run that portfolio to try and understand for us Aussies whether BHP should be in the portfolio or Rio Tinto or both, which are the banks, and where you stop, how many companies can you have. To do that, you'd have to develop a whole lot of stock specific knowledge. You've got to do a whole lot of research. Now, I get that some people like doing that, but it's just not necessary. It's like mixing your own drugs. If you've got a cold and need some cold tablets, you can just buy them off the shelf and they'll give you the result. Now, in theory, you could try and make that yourself, but none of us would. But lots of people try and make their own portfolios, hoping they can do it better. In the old days, so go back 20 years, people tried to run their own portfolios because they could do it cheaper. They didn't want to pay the 1% to 2% of management fees, so that was a valid reason. But fast forward, with index funds now pushing 40 plus years and being widely available, you can get access to the stock market for minimal, almost zero cost. And they're simple. One stock, one ETF, one listed ETF, can give you a whole market. So very easy to put together a portfolio of anywhere from 3 to 6 exchange traded funds, which will give you massive broad exposure. And I'll talk about some of that. And you'll find more information on our website about how to put together portfolios, how to plan, etc., where you don't have advice or you're not confident in doing it yourself. Now, the ultimate reason you're buying these is for long-term growth, if that's what you're chasing. So as part of your plan, you would have identified what sort of returns you want to achieve, what sort of risk you're willing to take, and then you can simply match and build a portfolio based on that. And that will give you the long-term growth of the market. Nothing more, nothing less, but that's okay because market returns are good. The share market in both the US and Australia over the last 100 years has averaged about 10%. So if you are in an index fund, you would have got that exactly. And sometimes they're a fraction out, and they can be unders or overs, but they're pretty much bang on. And I'll show an example in a minute. But a lot of people say, well, doesn't index mean you'll get average returns? No, you'll get the actual returns of the market, which is very different from active. So let's compare. Now, I've been following the studies on active management for literally well over 30 years. And every year, Morningstar, Delbar, there's a whole bunch of people do research that compare whether active managers, so these are fund managers who are trying to beat the market. Now, the investment industry creates this illusion that some people can beat the market. Now, while some can, it's very hard to pick them in advance. And it's also hard to know whether they've beaten it with skill or with luck. It's like if you tossed a coin 10 times and you came up with 8 heads, that's pure luck. Now, you could say I'm a head tossing expert, and some people might believe you, but in that run, it was just luck. So there are some very skillful people out there in the funds management world. The challenge is picking them ahead. Now, you'll find funds do all their advertising when they're ahead of the curve. So in other words, a fund will be saying, wow, look at our fund. It's performed 3% above the index. Now, that might be right, but did you invest 3 years ago, 5 years ago to get into that? And if you invest now, will they beat that in the future? Now, look at this article. And for those of you that are just listening, I'll talk through the article. But it's from Portfolio Advisor, an online website that helps portfolio managers, and it quotes Morningstar research that only 14.2% of active managers beat passives over the past decade. So that's over a decade, 14%. Now that only measures those that survived. So if you take out what we call survivorship basis, it's worse than that. My research over the years indicates somewhere between 5-7% of managers survive and beat the index over a decade. Now that's pretty woeful. So let's think of that in terms of odds. Some of you will know how to play blackjack, or 21 if you're playing in a casino. The idea is to get as close as you can to 21 and not bust. So picture you've got a 10 and a jack, adds up to 20. What are most people going to do in those circumstances? They're going to sit. So because they know that if they take a card, they're highly likely to bust. In fact, there's only one card, the ace, which would get them to 21, and there's 4 aces in a pack of 52, so that's a 7% chance of getting an ace. And that's a risk we would never take. And I watch people playing blackjack, and if they see someone take a card on 20, to take that risk. No one says that's only a 7% chance, but if you saw that, you'd say that person was crazy. But it's about the same odds of picking an active manager for the next decade, of beating the index, but that's exactly what people do all the time. So it's an illusion that it's possible, but it's very improbable. And in investing, you want to take the best odds. Now that means, and there's lots of people out there like us, for our private clients, we use about 70% index, and we top it with active management where we think there's a specific purpose. But for most people who are not getting day-to-day wealth management advice from people that have a whole lot of experience, you're better off with predominantly index. And index can be the core. Because one of the challenges is when you pay an active manager, they are 60 to 90% index anyway. So they will hold most of the stocks in the index. They'll hold some a bit more, they'll hold some a bit less. But if you took it out, they will be 60 to 90% index. But you're paying 1% or thereabouts instead of 0.05%. So a massive difference. So you could take the index and then, in a perfect world, just get them to pick their best stocks, not the whole thing. But that's not the way it works, although you can find some of those. So in this study, it also said, from the previous year, there was a slight increase. So in 1 year, 28% of people beat the manager in the year before, but only 14% beat the index for the last 10 years. And in the year, and this one's talking about last year, so this is an article from March, so it was less than a third, 29.1% to be precise, of active funds beat the passive counterparts in the previous year. Now you might say a third, that's not bad, but a third's pretty woeful. And when you compound that and you get 14% over 10 years, and that doesn't include those that failed along the way, it's less than 10%. So it's not great odds. In some areas, some funds outperform better, but you're talking about less bad. So in fixed income, for instance, the article goes on to say 26% of funds outperformed over the past decade. And you go, wow, that's better than 14, but it's pretty woeful. That's a quarter only. So your odds on of getting a fund, if you pick an active fund that's going to do less, not as good as the index. And let's keep moving there. I've got a lot here about costs, because costs, there's a few quotes from John Bogle on the screen at the moment, and I'll start with the one on the right, but I'll read it out for those of you that are listening. So before costs, beating the market is a zero-sum game. So if I'm trying to beat my competitor and we're both playing in the same market, it's a zero-sum game. So in theory, 50% of managers would beat the market and 50% of managers would underperform the market. But by the time you put costs in, this is why it's less than a zero-sum game. And as Bogle called it, it's a loser's game, because you take the costs out and it becomes very hard to beat the market over a long period of time, because you've got to beat. It's a bit like gambling at a casino. The casino has an edge. So if you gamble long enough, you will lose. Except in the few games of skill, of which there is not many in a casino. And if the casinos see people using their skill, they'll actually ban them. So yeah, in the market in terms of funds management, it's worse than a zero sum game. And some of those costs when you've got an active manager includes the management fees. They've got to pay very smart people to run, and they vary from 0.5 to 2%. There's transaction costs. The active managers tend to turn over more, so they've got more brokerage happening from the buying and the selling. And some of them charge performance-based fees, which you'd think that's a good thing, and maybe it is sometimes, but it also can encourage those managers to take bigger risks to shoot for that. And that means they can fade away, they can lose your money, and then they just close. So, yeah, I don't love performance-based fees because people think they're good because but they keep in mind, these guys, they're not just making performance-based fees. They take a base fee and then they'll pay. The typical performance-based fee for US hedge funds was 2% of any return above a benchmark. So that might have been above 5%. So anything they make above that, they'd take 20% of any return above a benchmark. So yeah, they might be making, and a typical hedge fund was charging 2% and then 20% of returns above, say, 5% with the risk-free rate. So they can make incredible amounts of money. But if you put them all together, that's that zero-sum game. There's very little chance of beating them. Another quote from Bogle: owning the stock market over the long term is a winner's game, but attempting to beat the market is a loser's game. Now, it's a seductive game. Everyone thinks that they're smarter than everyone else and that they can beat the stock market. The whole industry is built on this, and I'm going to talk about this in a couple of episodes, what I call the wolves in sheep's clothing. So these are people that are trying to help you plan your world, but they're just selling investment products with the illusion that they can beat the market. So let's have a look at another quote there. Index funds eliminate the risks of individual stocks, market sectors, and manager selection. Only stock market risk remains. So if we knew that the stock market was likely to do what it had done in the past, and let's say get returns of about inflation plus 5 to 7%, if we take an index fund, we are pretty much guaranteed to get the return of the market. If we take active managers, we might win, we might lose. We know from those odds I'm talking about and the statistics and the studies that we've got a 90% chance that we're going to underperform the market, which is not a smart thing to do. Now, the downside of index funds, and let me just go back. The downside of index funds is from time to time, if you're an index fund, you'll go over the cliff. So I'll give you some real life examples. If you go back to the COVID era, interest rates dropped to pretty close to zero. So if you're buying long-term bonds through an index fund, or if your super was buying long-term bonds through an index fund, you owned long-term bonds, even though the return was less than 1%. Now, it gets worse than that because as the 1% you could maybe cope with as a defensive asset. But the challenge with long-term bonds is when the market goes back up. So in other words, when interest rates go up, you'll make a loss. And that's what happened. Interest rates went back from sort of sub 1% up to 3 to 4%. And those bond funds lost 15 to 25% of capital value in what was deemed to be safe. Now, that was fairly obvious to some of us that had been around for a long time and had seen this thing happen before in the 90s and prior to that. But for lots of people, they hadn't seen that before, so they kept saying, no, you want to stay in bonds. Now, that was one of the times we, as managers for our clients, actively stayed out of the index fund and used active managers to be short-term with bonds where we didn't carry that risk. Now, if you this is very hard to do unless you've got people that can occasionally pick danger. Now, I'm not suggesting that we or anyone else can pick what markets are going to do, but every now and then the markets of an index, the risk reward gets out of whack. So you know, wow, this has gone like, and that exact example, when interest rates was zero, there was no chance of making much more than that unless interest rates went negative. And the likelihood, which was probable, that interest rates went back up, you're going to make a loss. Now, the same as if the share market's doubled in 2 years, that would, and which it did, for Nasdaq in the early 2000s, it doubled in less than 2 years, and it had doubled 3 times in about 6 years. So that's huge. And if you think about that, picture the ASX 200 at about 9,000 at the moment. Now, it's quite a while. It's about 8 years since it's doubled at the moment, which is fairly normal. You may have heard of the rule of 72. The rule of 72 just says if you divide a number into 72, you'll get how long it takes. So if you're saying a 9% return, divide 9 into 72, you get 8, and that's how long it takes an investment to double. So when I see a market like the Aussie market has doubled in 8 years, I know it's had a 9% return, and I compare that with history and I go, that's bang on average. So that's neither hot nor cold. At the moment, though, we look at the S&P 500, which is sitting on a 15% 10-year return and 3-year returns of 25 or so. So it's a hot market. Now, if you invest in an index fund, you will ride that all the way up and you'll ride it all the way down. And if you stick through it, you'll be absolutely fine in the long run. The challenge that you can have is that some people will make bad decisions when markets go down. So when there's a big crash, and I'm not talking about a 5 or 10% correction, but when there's a big crash like GFC in 2007-8, when the share market went down 50%, some people will panic and get out. There's really only 3 ways that people lose money on the share market. One is if they panic and sell when markets are down. The other is if they have to sell because they need the money when markets are down. And the third is if they're not truly diversified. So if you avoid those 3, and it's very easy to do with index funds, you will prosper, but you will put yourself in this lemming-like situation once every 20 to 25 years. Now, for most people, that's going to be worth it, but sometimes it's nice having some wise voices around that might tell you when it's a good time to take a profit, or have a little bit less in shares, and certainly avoid the danger of taking too much risk when markets are running hot. So let's have a look at types of index funds, and 3 broad types. You've got multi-sector or diversified, and a good example of that is the Vanguard Balanced Index Fund. You'll also find them by BlackRock and Beta Shares in Australia, and lots of them around the world. So you can see, and I'll talk through this as well, but this is the most diversified fund in the world. It's 50% growth assets, so that includes Australian shares, emerging market shares, hedged international shares, unhedged international shares, and international small companies. And it's also got 50% in bonds, Australian fixed interest, and international fixed interest. Incredibly diversified and incredibly cheap for around 20 basis points. That means 0.2 of 1%. You get a completely diversified balanced fund. And you'll see the range of each asset class there is relatively tight. So this fund is very predictable. Now, Vanguard does not pretend to be an active manager. They're purely index. So in the long run, they've been superior to the averages. But occasionally, if one of those indexes does badly, like the fixed interest I talked about, they had a couple of years where they did under average, but they're certainly back again now. Now, don't rush out and buy this without doing research. You can find more information on our website about investing, and certainly listen to this, and some of our courses can help you as well. Then you've got the broader indexes, so that's taking a step down. So the Vanguard was diversified, lots of different categories. So then you've got one like A200, one of Beta Shares, which is the cheapest Australian index fund. So 4 basis points, so 0.04, almost nothing compared to the 1% that we used to all pay for active managers. And you can see that a chart, or I'll talk through this chart, which is from Morningstar, which shows the last 10 years returns and compares A200, which is the index fund, to the index. And you can see A200 is actually slightly above the index. Now, people say, even if you've got a low fee of 0.04, how do you get slightly above the index? Now, they do this because they operate, not all of them, but some of them will operate a thing called stock lending. Now, this is complex. but let me try and explain it. You may have heard people talk about short selling. So that's when you sell some stocks you don't own, and that can include the index. So hedge fund managers, speculators, people trying to manage their risk will sometimes sell short something they don't own. Now, they can't legally do that unless they borrow that stock from someone else. So big funds like Vanguard, Beta Shares, BlackRock, they lend the stock. They don't lend all of their stock, but they lend some of their stock, and they receive some fees and some interest for that. And eventually those people buy that stock back and they get their stock back. It's very highly regulated. It's only done by big institutions, and it is a bit of a free lunch. So that means they're actually earning more than the index, not by much, but enough to show that in this case, $10,000 invested 10 years ago in A200 grew to $19,500. If it was in the pure index, which is impossible to do unless you use an index fund, it would have been $19,375. So almost exactly the same, slightly better. So effectively, even though it's 0.04% as the cost, it's been effectively free because it's done better than the index. Vanguard Australian Share Fund is similar to that, but have a look at the yellow line. I'll talk it through as well. But the category, so average managers in that category only turned $10,000 into $17,800. So not quite, but almost 2,000 below that over that time. Now that's compounding all those differences I talked about. And it's 15, what have we got? 1,700 is the difference on 10,000, 17% over 10 years. So that's huge. And that's off $10,000. So imagine your investment, if it's $100,000 or $1 million, yeah, it's $170,000 on $1 million of having the average manager result compared to an active, compared to an index fund. That's absolutely huge when you start to talk about that being in your pocket and available. And then you've got sector-based indexes. So this, I've got an example of a gold one by VanEck, gold miners. So you can buy a bunch of gold miners, in this case 82 stocks with one trade. So if you decided that was a theme you wanted to jump on, and just to remind you again, I'm not endorsing any of these investments I'm talking about because I don't know you and your circumstances. They're all appropriate if they fit your plan and if they fit your strategy, but we're talking about tactical decisions about exactly what investments to buy. But in an incredible way, you see that one has a cost of 0.5. So in theory, and in this case in practice, it will underperform gold by 0.5%, but that's okay. You've got to have a cost. Even if you go and buy gold bullion, you've got to pay someone to store it for you. Some people, they will insure it as well. So there's a cost to everything. You're just trying to make sure you pay a reasonable cost. And these guys, and that's a passive index that is attempting to match a gold miners index. So other examples of sector-based index might be technology. It might be healthcare. So these are bets that some people like to place on a sector that they think is going to outperform the market. That can be hard to do, but sometimes that works quite well. You've just got to be careful about doing that stuff without the guidance or the help from people. So yeah, wrapping up, index funds, love them. Be very careful. Don't just assume they're all created equal. Need to do your research. Lots of stuff that you'll find under the bonnet with our services, but they're a great way to make sure that you get good returns. Now, good returns as opposed to the best returns. In theory, over the last 10 years, there was 10% of managers that did better than the index. So in theory, you could have beaten the index, but who wants to take a 10% chance? It's just not worth it. Or who wants to take a 10% chance with all of your super? And this is where we start to use strategies like core and satellite, where you might go, okay, we're gonna take 70-80% of our investments, and we'll use boring old index funds for that. But then we'll try and be a bit smarter for the other 20 to 30%. Still hard to do, and that smarts can be generated from stock picking, or it can be generated from macro stuff, which is wisdom, what I call wisdom-based stuff, where you might take a bit extra of a certain sector if you think it's going to run for longer, like technology, or you might actually tap out of something that you think is run too hard. Incredibly hard to do unless you've got really good support. And you might do it for different reasons, some being risk management, rather than just trying to get high returns. Lots of nuances with things, so do your homework carefully and get advice. And if you want to compare how your current funds are doing, you can compare it to a good index fund. So this is really important. So if you're in an industry super fund and you're in an Australian share option, you can look at what it's done for the last 3 years, 5 years, 10 years. You can compare it to an index fund, and that will tell you whether they're above or below the benchmark. You can also look at Morningstar, free information, and compare. It will compare your fund over the last 10 years to the index as well. If you're in a diversified fund, you could compare it to the Vanguard diversified funds. Make sure you're comparing like for like. There's a massive difference in our industry about how people classify things. So as an example, a balanced fund for Vanguard is 50% growth, 50% defensive. For other funds, it could be 70% growth and 30% defensive. So very hard for the average punter to work out, well, what's a balanced fund? So make sure you're comparing apples to apples. Hopefully you enjoyed that. Hopefully you get something out of it. As usual, feel free to like, subscribe. Based on the channel you're listening here, you'll get notified of all our info. We love comments. We love feedback. Let us know. We can custom some of these episodes to suit things you may be wondering about or things you may be looking for information about. And check out our website, runwaytoretirement.com. You can download for free our 5 essential steps to an awesome retirement. And there's also lots of other info, courses, and things that can benefit you if you're either learning or doing it yourself. We also have a service that if all of this sounds too hard, we can find you an advisor, and just click on Find Me an Advisor, and you'll find, and we'll introduce you to an advisor who's accredited with us, who we have confidence will look after you very well. Until next time, Rob McGregor signing off.